What is a steep yield curve? Imagine looking at a graph that shows how much it costs to borrow money for different lengths of time. If the line slopes sharply upward from short-term to long-term bonds, that's called a steep yield curve. This means that long-term bonds are offering much higher interest rates than short-term bonds. When you see a steep curve, it usually signals that investors expect the economy to grow stronger in the future. They might also be worried about inflation rising, so they want higher yields to compensate for that risk. For banks and credit unions, a steep yield curve can be good news. They typically borrow money at short-term rates, like from customer deposits, and lend it out at longer-term rates, like for mortgages or business loans. When the difference between short-term and long-term interest rates widens, their profit margins grow. That means they can earn more from the loans they give out compared to what they pay on deposits. This extra profit is called net interest income, and it often increases when the yield curve is steep. A steep yield curve can happen in two main ways. One is called bull steepening, where short-term rates fall faster than long-term rates. The other is bear steepening, where long-term rates rise faster than short-term rates. Usually, a steep curve appears when the economy is recovering or expanding after a slowdown or recession. Central banks might lower short-term interest rates to stimulate growth, while investors demand higher yields on long-term bonds because they expect inflation and economic activity to pick up. But it's not all positive. A steep yield curve can also mean inflation might be on the rise, which can cause problems for lenders and borrowers alike. Banks and credit unions need to manage this carefully. They might adjust how they price loans or decide how long they want to hold certain investments. They also keep an eye on inflation risks that could affect their profits or costs. In simple terms, a steep yield curve shows that long-term bonds pay much more than short-term bonds. It reflects expectations of economic growth and rising inflation. For financial institutions like banks and credit unions, this environment often means more profit opportunities. But it also means they need to stay alert and manage the risks that come with changing interest rates and inflation.